Hi, welcome you all. This is Nagarjun CA Nagarjun, being moderator for today's session on the webinar of Introduction and Intricacies of Foreign Tax Credit. Today, we will be deliberating on the basics of the double taxation, the need for foreign tax credit, and how to eliminate the double taxation with the help of foreign tax credit provisions. Today we have with us CA Piyush Chajat, the Direct Tax Committee Chairman of DTC of ICI, and Mr. SP Singh, ex-IRS, and the speaker for the today's session, CA S. Krishnan from Bangalore. I welcome you all for the today's session, sir. Let me introduce you Mr. Piyush Chajat, the Direct Tax Committee Chairman of ICAI. He's a chartered accountant in practice for over 2 decades. His specialization in direct taxes and indirect tax appellate proceedings and arbitration proceedings. He's a member of Working Committee of Asian Federation of Accountants, the speaker on various topics on direct taxes. I welcome you, sir. Today we have with us Mr. SP Singh, is an ex-IRS. He served with Indian Revenue Service for more than 2 decades. He has held various positions, including Director of Income Tax International Taxation and Commissioner of Income Tax Appeals. Sir, we welcome you, sir.
Thank you.
And today's speaker, CA S. Krishnan from Bangalore. He is an expert in the international tax domain. He has published an elaborate discussion paper on drafting foreign tax credit rules in India. He was earlier Vice President and Group Head International Taxation at Infosys for over 15 years. And he advises companies on international tax structuring and performs the role of virtual international tax manager, providing tax health checkups, etc. And he has been author of books relating to startups in India and abroad. I welcome you, sir. I request SP Singh, sir, to give the opening remarks and overview of the session.
If we hear Piyush ji, before I come to the subject matter, Piyush ji, always the actions, he acts himself with. Yeah, Piyush ji, after you.
Thank you very much, SP Singh sir, moderator for this session, Nagarjun ji. Thank you very much. Speaker for the day, Krishnan ji, will be taking a very important subject on foreign tax credit. The problems which we all are facing day by day. We are not getting credits, how the forms has to be filled. First of all, whether you can actually avoid claiming foreign tax credit so that there is no tax deduction at all. I'm sure Krishnan sir will be deliberating this, is the expert on that. SP Singh sir, ex-IRS officer, advisor to Direct Tax Committee, of a very immense helpful, and he has always been available to DTC. Thank you very much for joining. And as I'm speaking, I'm seeing on the screen my Vice Chairman Kota Srinivas has also joined on the screen. So I'm sure he would be also addressing. In fact, he was supposed to address before me, but Kota ji has started. I'll just take some few minutes and then I come back to you if it's okay with you.
Yeah, no problem.
So, the Kota Srinivas, Vice Chairman of Direct Tax Committee, who is a big support to this committee, DTC, and holding my hand, always been with us. So we both of us are doing our best to see that Direct Tax Committee is able to deliver what it has objective is to deliver to the members at the large. As you may be aware, this is a very important month, I know. And the next month would be September, when the tax audit season would be coming. I am receiving a lot of queries from the members stating that whether we will be receiving any guidance note on tax audit for the 2024. So for the sake of clarification, which I am also speaking largely on all the public platforms also, you may be aware that guidance note on tax audit was revised in 2022 after a gap of 8 years. Thereafter, the revised edition came in 2023. This year, generally, whenever there is a budget, after budget, we try to revise the guidance note on tax audit. This time committee decided, because we knew that the budget would be coming after the election, it would come in month of July and August. And generally, as the process stands for the guidance note, that first the committee has to draft, it has to be approved by, group has to be formed, drafted by the group, approved by the committee, then it goes to council, then there is an exposure draft, then again it comes back to the council. So it takes 3 to 4 months. So what we decided in very early February itself, when the new committee took over, that we will not revise guidance note on tax audit this year. So please keep it in mind. There won't be any revision guidance note on tax audit 2024, which is expected as decided by the committee. But to take care of the amendments which were made in Form 3CD, that is revision in Form 3CD was done in month of March 2024, notified in March 2024 by the CBDT. And hereafter, there was also one corrigendum issued wherein major changes in regard to 43B subclause H reporting was introduced in Form 3CD. So we decided at that time itself that we'll come up with an implementation guide to implement the guidance note of edition 2023. So my request to all the friends is, when you are discharging your audit and assurance functions, when you are certifying Form 3CD, 3CB, 3CA during this particular audit sessions, please do look into the guidance note. Obviously, there may be some changes which have happened in this particular budget, but that does not impact you as far as audit of financial year 23-24, assessment year 24-25 is concerned. Whenever we do a revision of guidance note, subsequently, we'll try to incorporate those changes in that particular budget. So just I thought I'll clarify this. Apart from this, because as you all are aware that this year trust audit will also applicable, we have already come out with guidance note on audit of charitable institutions, that is 10B and 10BB. Certification has to be done by the auditors in Form 10B and 10BB. The implementation guide which came was last year is replaced with the guidance note, which is at higher pedestal, and it is as good as mandatory for the members to follow that when you are discharging your audit functions. So please do look into it. You have a sufficient time for the certification of the audit. Either it's a business audit or either it's a charitable trust audit in 10B and 10BB. So that guidance note, you can refer to it. It will definitely help. Of course, today we are talking about international tax. This webinars on and every week we are organizing since the month of February. 1 week we are choosing a topic on direct tax, and 1 week we are choosing every alternately on international tax. Foreign tax credits is a very important. I'm sure Kota Saab, Vice Chairman, would be giving an opening remarks, and SP Singh Saab would be also touching upon it. Just on an international tax front, just for the benefit of the members, as you may be aware that we are already having a diploma course on international tax course, which is very much recognized. And we do it online also and offline also. And some branches express its interest to do it a physical batch of such diploma course, and they have a sufficient members, 40 for the metro cities or tier 2 cities, 30 members. We allow them to do that certificate course. Similarly, if we have a 200 members on the online batch, we do it on an online mode. Generally, whenever we launch a batch of an online mode, within 10 days, 200 registrations are full, and it is very much successful. After that course is over, physical learning is over, we also have an examination which is conducted by the exam committee. So very important, as you know, anything done by the exam committee of the Institute of Chartered Accountants of India is very high pedestal. It has a very good importance, which is recognized by the court. And fortunately, my vice chairman is also the member of the exam committee, who is doing so well, and he has kept the exam standards always at highest level. The examination, I'll just give you a small, very small statisticals. Up to for diploma, 6,000 plus members have already completed the course, but the passing percentage has been around 10 to 15%. Around 600 members have only passed. So that's the level of the examination which I'm talking of. But it's not leading examination and obtaining certificate course, but that course is quite well laid down. It covers all the aspects of international taxation in depth. So my request to the members who are interested in developing their practice in international taxation, mastering it into international taxation, they should look forward to this course. They may join that particular course, and surely it will help. Apart from that, we have a certificate course on UAE corporate tax, which is also done on the online mode, and that also course is largely accepted by the members in India also. So like we have, likewise I said, we have a limit of 200, and as soon as we launch such that course, we get immediate registration also. So please do look forward to such courses. It will definitely help you whenever you are advising your clients on cross-border transactions. So with this, with very limited, I would wish you a best. I don't think so we have much webinars whereby myself and my vice chairman would be attending. Of course, there would be one webinar coming on 29th, and that would be possibly the last webinar which myself and my vice chairman would be addressing, because my members know that we are a part of a democratic institution. Elections would be coming. A strong code of conduct is already in place, and therefore maybe after a week's or time, we may not be available as far as on such webinars is concerned. But for any queries of the members, we are always available on dtc@ici.in. You can also write your direct mails to myself or my vice chairman. Believe me, each and every mails would be responded to the members. So we are always otherwise available. We may not be available on such webinars. So thank you very much once again to all of you, and have a very good learning. So over to you, Nagarjuna sir. I think so Vice Chairman has joined, so he can address after his introduction. Nagarjuna, please.
Thank you. Thank you for that insights of what is happening inside the institute, sir. Thank you very much. And today we have with us Mr. C.A. Kota Srinivas, who is Vice Chairman of the Direct Tax Committee of ICAI. He has been in practice in direct taxes for over 2 decades now. He served the institute as a student committee member of SICASA Bangalore branch. He's been 9 years as served 9 years as managing committee member of Bangalore branch of SIRC of ICI. He's been as regional council member of SIRC of ICI for 9 years, and he is the domain expert. He has presented papers at various study circle meetings, workshops, seminars, and conferences on topics covering direct tax and especially international taxation. He's also a visiting faculty at ICI Bangalore and also an author a book named CA Referencer for Chartered Accountants. Sir, we welcome you for the webinar.
Thank you, Nagarjun, for the brief introduction. First of all, am I audible?
Yes, sir.
Hello, am I audible? Yeah.
Yes,
so
sir.
I welcome the speaker of the day, a good friend, Krishnan from Bangalore, and our mentor, I should say, SP Singh sir, welcome to you. And my council colleague and my chairman of the DTC, CAPUS Chartered, and all the secretary and other staff of DTC who are present here, and all the members who have come to witness or learn about this foreign tax credit. In fact, I should thank Krishnan for accepting our invitation, because it's not just he'll be talking about theoretically, but he has got a very, very wide exposure and experience in this foreign tax credit, because he has served more than a decade in Infosys. And when we talk about, or when we do with foreign tax credit, we may be only dealing with India and some other foreign country. But here is a person, I should say, who has not only dealt with 2 countries, that is India, one country and the other country, but he has dealt with different countries foreign tax credit, maybe USA and Singapore, Australia and USA, India and Singapore and Australia. So, because as you know, Infosys has got a presence in many countries across the globe. It's a multinational company. So he has worked there. So today he'll be dealing with us or taking us through introduction and intricacies of foreign tax credit. Initially we would have thought, why foreign tax credit to all the practitioners? But when when we are into practice, we may come across certain situations where one of our associates would have worked abroad for 2 months or 3 months, or even working in India. Maybe there are many situations where they get these sort of foreign shares, foreign company shares they'll get as ESOPs, and sometimes it so happens that they will get an ESOP. To pay that perquisite taxation, they will sell the shares, and then they will do the taxation they will recover. Plus, dividend will come, then there may be capital gains. So there may be tax deduction in various countries. So to know more about that, of course, Krishnan will be a very good faculty who will take you through. There are different types of foreign tax credit that we'll get. If you just go through the DTAs that India has entered, there may be under Section 90 where we have multilateral, like unilateral agreements, or bilateral agreement with other countries. And when there is no agreement between India and other countries, it will be Section 91 unilaterally. You can take the credit. And as far as my knowledge goes, we deal with the indirect tax credit. So where we take the income also, and we also take the credit, the lesser of the taxes that has been paid as per Indian income tax and as per that particular country. In fact, in this recent amendment, Section 198 also, there is an amendment where has been clearly mentioned, whatever the foreign tax credit you take, that is also treated as income. Earlier, they were talking about only tax related source in India was considered as income. But now it has been clarified. It's not that we are not taking that as income. Now it has been clearly clarified in Section 190. They've added that even foreign tax credits, whatever you take, that also is forming part of income. So with these few words, once again, I welcome each and every one of you for this webinar. Since I've got to address some of the, like I've come to income tax, you don't have to address, I have to make an address. I'll take leave of all of you. I wish this particular 2 hours of discussion, deliberations by Krishnan definitely will help each and every one of you to know and understand the foreign tax intricacies. Thank you, one and all. Go to Nagarjun. And I should also thank Nagarjun for accepting my invitation to become a moderator for this particular session. Thank you, Nagarjun. Over to you, Nagarjun. You're on mute.
Yeah. Thank you, sir. Over to Mr. S.P. Singh. Sir, could you please give the overview of the session and hand over the session to the speaker?
Thank you. Thank you, Nagarjun, and for the nice, crisp introduction. It's always my pleasure to be, in the webinar, and when the physical classes were being held, for the diploma course, it was always, a rich experience, addressing the people and interacting with them. Good evening to all the attendees, all the participants, and special thanks to Piyush Chaudhary and Kotaji for being present, and particularly thanks to Krishnanji and Nagarjunaji for taking this session forward. As everyone has rightly said, foreign tax credit is a topic which has become very important, and with the vast knowledge of Krishnanji, it will be really nice to hear. I will just share with you a very interesting story, to start with. Recently, the son of one of my friends returned to India on a long assignment, and his father brought him to me, saying that, I have been dealing with international taxation. So he is full of energy to be working in India. And he said that now he has to bother only about the income or the salary which he receives in India. Then I took him through, I said that, no, look here, you have come in July, so you will become resident because you will be spending more than 180 days in India. Therefore, your global income will be liable to taxation. You see that my, my advisor in US said that I will have to pay tax on my income in US, particularly in respect of rent, interest, and all those things. So why should I pay tax again in India? So I had to take him through, the concepts that, once you become a resident in India, then in that case, your global income is liable to taxation. So that if it so happens, then I will have to pay tax on the same income in two jurisdictions in US and India. Then I had to talk about, how the credit has to be taken. Friends, this is not an incident which has happened with me, but it must have happened with many of you, and may happen in future with many of you. And it is happening because, the globalization and digitalization of the economy which is happening. People are moving from one location to another. People are investing from one location to another location, carrying on activities in different locations simultaneously. So when this is happening, there is fear of erosion of the tax base, and the tax department all over the world are becoming very, very aggressive. Now, how do they become aggressive? They become aggressive by taking more and more rights to tax income. So they increase the scope of taxation. And once they increase the scope of taxation, it's bound to overlap with the taxing jurisdiction of another country. Now, once this happens, this is the jurisdictional double taxation. So same income being taxed in two jurisdictions on the same income in the hands of the same person. That is the juridical double taxation, which is the most common one. But there is another one also where, the income may be taxed in the hands of two persons, like transfer pricing for the same year. So these two type of double taxation are definitely, detriment to the growth of international trade. And the tax policy makers have been very, very aware of this and have been very actively taking measures to deal with this. So far as the juridical double taxation is concerned, it is, as Piyush mentioned, that it can be, and Kotaji mentioned that it can be unilateral, as in case of India, it is through Section 91. It is good, but it is not comprehensive. The comprehensive result is obtained when, the double taxation is removed through a tax treaty. And once they remove through the tax treaty, there are two types of ways by which a double taxation can be removed. Either you exempt the income, or you allow the credit of the tax paid in the other jurisdiction. Now, exempting income is very simple. It's very easy. You simply say that whatever income somebody earns outside India, India will not tax it. But when India does this, or the countries which are in position of India, like developing countries, they will be losing a huge amount of taxes. So it is something which is good conceptually, but it's not good for so far as the tax revenue of a country is concerned. So the people move to the other type of removal of the double taxation, which is the credit method. And in the credit method, again, there are two types. One is the comprehensive or full credit. The other one is the partial. So in full credit, you allow the entire amount of the tax, which may at time result in a refund in your country. And the partial one is that you allow only to the extent of the tax rate in the country of residence. So there, the bottom line becomes that there will be no refund, when the country of residence gives credit of the taxes which are paid outside. The third one, which is normally, developing countries insist upon, is the tax sparing, because India, there are many provisions, or there had been many provisions where taxes were exempt, income were exempt from taxation in order to help, industry or services. But if the same income is taxed outside, then in that case, it's India supporting the tax base of the other country. And therefore, India has been insisting on tax sparing clause, saying that if India exempts a particular income, the other country will exempt that income for the purpose of taxation in the source, in the residence country. That's a real benefit to the investors. It's so far which I have talked about looks very, very simple, but foreign tax credit is full of many pitfalls. And those have to be taken into account. There are challenges in implementation, and Krishnan will take us through. He will take us through how the double taxation happens in India and how India has decided to deal with it, what the law for that, the procedure, and what are the litigation involved in tax credit, and what's the way forward. A big, the guidance, and with the experience which Krishnan has, it will be really a treat to listen to him. Over to you, Krishnanji.
Thank you, Singh ji. Thank you, Nagarjun, Kota, and Piyush. Let me share my presentation. Is this visible?
Yeah,
Yes, sir.
it's visible.
Okay. Okay. So there was a very nice introduction given by Mr. S.P. Singh about foreign tax credit and various issues. So he also has talked about the origin of foreign tax credit. Today, when we are talking about foreign tax credit, it is basically a solution. So we need to understand first the problem, which is essentially double taxation. So when we talk about double taxation, let us look at the concept of double taxation. As there are two sources of income for a taxpayer anywhere in the world. domestic source income earned in the country of tax residence and foreign source income earned outside the country of tax residence. In India, the quantum of foreign source income over the last about 3 decades from 1994 onwards has been significant, largely due to the presence of software services companies, as they were earlier called. Now they're all called IT companies, because of which a large number of companies were able to provide services from India to their clients outside India. A large number of individuals were traveling outside India. So to that extent, they used to get foreign source income if they were based in India. And also off late in the last decade or so, there's a greater degree of investments by individuals and institutions outside India as a part of de-risking strategy and things like that. So under the circumstances, the foreign source income is something which has been increasing and which is essentially income which is earned outside India. Now, the internationally accepted regime is that the source country has the right to tax. That is the country where it is earned. They have this right to tax, though this right may be limited by a treaty through a lower rate. What it means is if the country, for instance, US has a 30% withholding tax rate, and treaty reduces the withholding tax rate for instance, for interest and dividends to a lower rate. And the residence country is always responsible for relieving any double taxation that arises. I'm referring to double taxation, not foreign tax credit. So this is something which is a fundamental concept which a large number of people sometimes don't understand. It is not that you can take a credit or anything wherever you want. The residence country is always responsible for relieving double taxation through whatever mechanism that it chooses to. So the source country has the right to tax and is always a residence country which relieves double taxation whenever it arises. Now, there are 2 types of double taxation, as Mr. Singh talked about: economic and juridical double taxation. Economic double taxation arises when 2 different persons are taxable in respect of the same income. For instance, corporate tax, this is something that we are all very familiar with. Corporate tax paid by companies on their profits, and income tax paid by shareholders on the dividend income distributed from such after-tax profits. And then, as Mr. Singh talked about, there is also an expense disallowance. For instance, income earned by one person is an expense for another person. During an audit or during an evaluation of an income tax return, if a particular expense is disallowed, to that extent, there is a double taxation. Now, double tax, there is no solution to this kind of a situation unless it is litigated to that extent. Whereas in the case of dividend income, some countries provide relief by providing underlying tax credit, whereby the tax paid by the company declaring the dividend, the income tax, corporate tax paid by them, the shareholder can take a percentage of based on the percentage of holding in that company, they can take a credit. But there are certain rules associated to that in terms of holdings and things like that. Now, in the case of economic double taxation, it can arise within the same country or it can arise from different countries. For instance, Indian subsidiary declaring dividend to a parent company, or a foreign subsidiary declaring a dividend to a parent company. So it can be both within the same country, or it can be cross-border also to that extent. The next type of economic double taxation is what is more popular, which is juridical double taxation. This arises when the same person, if you go to economic double taxation, there are 2 persons always, but the income is the same. Whereas in the case of juridical double taxation, the income is the same and the person is the same, but it arises in more than one country, both in source country and residence country. So this will arise when a foreign country taxes the foreign source income of a taxpayer. When they tax it, it can be either through a withholding tax or through a payment of taxes. And the residence country taxes the worldwide income, which is domestic source income and foreign source income of its resident taxpayer. So this results in double taxation, where the person, as Mr. Singh talked about, pays taxes in the foreign country as well as in the domestic country or the residence country where the person is a tax residence. So these are the 2 kinds of double taxation that arises. Now, what is the mitigation for this double taxation, which is what is called as elimination of double taxation? To my mind, there may not be a complete elimination of double taxation, and that is what we want to talk about. But the intent is, how do you reduce the impact of double taxation or mitigate the impact of double taxation? Now, if I look at the methods for elimination, there are two methods for elimination of double taxation prescribed under the UN and the OECD model. There are two tax conventions in the world, the UN and the OECD model tax convention. Both these model tax conventions have Article 23 incidentally. In both these conventions, this is Article 23, which deals with alternatives to eliminate double taxation. And both these treaties have provided two types of methodologies. One is the exemption method and the credit method. Under these methods, as I said earlier, the residence country is obligated to eliminate double taxation. The source country will charge, the residence country will eliminate the double taxation. Under the exemption method, the foreign income is exempt from taxation in the residence country. Under the credit method, the residence country first determines the income tax payable on global income or worldwide income, which is both domestic income as well as foreign source income, and then provides a credit or deduction from his income tax for income tax paid in the foreign country. The moment we talk about a deduction, the first thing which comes to our mind is it's an expense deduction. No, this is not an expense deduction. This is a deduction from the income tax, similar to a TDS or an advance tax, so to speak. So whatever tax that you have paid there, you will be able to take a deduction, or you will be able to reduce the global income tax in India to that extent. Now, how is this implemented? DTAAs, or double tax avoidance agreements, as it is popularly called, they provide the mechanism to eliminate double taxation of the same income in two countries. And this is popularly called as bilateral relief. In addition, many countries provide unilateral relief from double taxation through domestic tax law. India provides unilateral relief through Section 91 of the Income Tax Act. A claim, this is something that I just want to clarify. A claim for refund of taxes in the source country is not elimination of double taxation, but refund of excess income tax. For instance, there are a large number of NRIs in India who file an income tax return and seek a refund of the withholding taxes in India. So that is not an elimination of double taxation. It is basically a refund of excess tax paid in that particular country. Now, if you see a pictorial representation, this is what it is. You have two methodologies. One is the exemption method and one is the credit method. And under both of these methods, there are two methodologies of seeking credit. One is a full exemption under the exemption method. Exemption method basically means that the foreign source income is not even considered for taxation. So under the full exemption method, the entire income is not considered for taxation. So there is no question of elimination of double taxation because there is no double taxation here. What is paid in the foreign country is paid. What is paid in the domestic country is separated. Exemption with progression basically means that under this methodology, while the foreign income is not taxed in the residence country, the foreign income is considered for determining the tax rate through which the domestic income is going to be subject to tax. While foreign income is not subject to taxation, that is considered to determine the tax rate on which the domestic source income is going to be taxed. This is the income approach under the exemption. Income is exempt. Under the credit method, essentially, you go through the full rigmarole of paying taxes, and then you take a credit of the taxes, and that is why it is called a tax approach. We will see this a little more in detail. Majority of the countries in the world have chosen to opt for credit method. So we will examine that a little more in detail. Now, under the credit method, as I said earlier, the residence country, always the residence country eliminates double taxation. The residence country includes the domestic source income and the foreign source income. Global income is going to be taxed in that country. And then they calculate, just like in India to that extent, calculates tax on the taxpayers' worldwide income. So this is where the confusion sometimes is. People who come from abroad, they think that whatever they are earning in their country or wherever they have worked, they have to pay taxes. They don't have to pay taxes in India on their worldwide income. And this is something which is basically ignorance of tax to that extent. Till they talk to somebody like a chartered accountant in India, they may not be able to be aware of this particular situation. So essentially, under the credit method, income tax is first determined on the global income and global income tax payable. And then it allows a credit or deduction from its income tax. To repeat again, deduction from its income tax for taxes paid in the foreign country. Now, there are two methodologies that you have here. One is what is called as a full credit method. Under the full credit method, whatever amount of taxes that you have paid there, you will get a complete credit in India, in the residence country to that extent. Under the ordinary credit method, you will get a credit in the residence country only to the extent of tax payable on that source income, on that foreign source income, based on the tax rates in that residence country. So under the ordinary credit method, the amount of credit that you can take is basically restricted to the amount of taxes payable in the residence country on the foreign source income. This is the fundamental difference. Again, majority of the countries have chosen to give an ordinary or a proportionate credit method in their domestic tax laws. Now, what does it mean is, what is the basic difference in terms of the full credit method and the ordinary credit method in terms of an impact on the economy of the country is, under the full credit method, the residence country will have to use the income tax collected on domestic source income to provide foreign tax credit. Whereas under the ordinary credit method, whatever taxes is payable in this country, they will get credit only to that extent. So to that extent, the tax collected on the domestic source income will not be affected. This is something significant. So to that extent, ordinary credit method is something which is predominantly used by many of the countries because they don't want to give away a portion. They don't want to subsidize the domestic income tax for foreign income tax to that extent. That is the methodology of elimination of double taxation. Now, the India follows, of course, the ordinary credit method and the Income Tax Act, and in majority of the DTAs. Under the ordinary credit method, the tax cost of foreign source income is either the higher of the residence country tax or the foreign country tax. For instance, let us assume for a moment that the tax on foreign source income is, let us assume, $200, and the tax on that foreign source income, domestic tax on that foreign source income is $100 equivalent. Then you will be able to get credit only in India to that extent of $100. So $100, so the entire $200 paid outside India will be a total cost. Let us assume for a moment that the tax cost in India on the foreign source income is $200 and the tax paid in the foreign country is $100. So because you will get a credit only to that extent of $100, you will pay $100 of tax in India and $100 of tax outside India. So to that extent, the tax cost is going to be $200. So always under the ordinary credit method, the tax cost of foreign source income for a taxpayer will be either the residence country tax or the foreign country tax, whichever is higher. And the only exception that India has done is adopted full credit method in its DTA with Namibia, which is a very small country in terms of revenues and things like that. Now, what is the impact of this of the methods for elimination of double taxation? We have not even come to foreign tax credit yet. We're only talking about there are two methodologies, and within the two methodologies, again, there are two manner in which the double taxation is eliminated. So what is the impact of these four methodologies that we have examined so far? Now, elimination of double taxation through the exemption method basically says it removes the right of the residence country to tax foreign source income. This is the best situation ideally, because you don't have to go through the rigmarole of foreign tax credit and how to determine foreign source income and things like that. And obviously, you don't have to attend a session like this to that extent. So the foreign country taxes foreign source income, the residence country taxes the residence country to that extent. The impact to the taxpayer is going to be a combination of both the taxes paid in both the countries. Now, the elimination of double taxation through the ordinary credit method also basically means that you don't have a right to tax foreign source income. That is predominant. Except when the foreign country does not tax. There are still some countries which don't tax income tax. So in such circumstances, if there's an income for a tax resident from those countries, India will, the residence country will get to that extent the share of taxes. Or if the residence country rate is higher than the foreign country rate to that extent. So under these circumstances, the residence country will be able to collect taxes. Otherwise, there is no difference between the exemption method and the ordinary credit method. Also, there may be some amount of taxes that the residence country takes depending on how the credit mechanism is implemented, which we will examine a little later. Now, ordinary credit method is predominantly used in India's DTAS and in many other DTAs around the world. The ordinary credit method, as we talked about earlier, the total cost to taxpayers is the residence country tax or foreign country tax, whichever is higher. Full credit method, okay, results in the lowest amount of tax payable to the taxpayer. Generally, there is a perception that full exemption is results in the lowest amount of tax payable. It is not full exemption which results in the lowest amount of tax payable to the taxpayer, but full credit method, because under the full credit method, if the foreign tax payable is higher, then the domestic income is subsidized to that extent. And exemption method, the problem that you have with the exemption method is it may result in double non-taxation, particularly when the foreign country does not tax the foreign source income. So foreign country does not tax the foreign source income. The domestic country does not tax the foreign source income. So under the exemption method, there may be a possibility of a double non-taxation to that extent, which does not arise in the case of a credit method, because under the credit method, if the foreign country does not tax, then under the ordinary credit method, you will have taxation in the residence country to that extent. So this is the impact of the methods of elimination of double taxation. Now, this double non-taxation is something which has been addressed in the past about 15 years or so through the BEPS program. There has been the OECD G20 inclusive framework. They wanted to look at base erosion and profit shifting. There have been accusations of companies operating from low-cost countries or tax havens and things like that. So they wanted to address the issue of non-taxation in some countries. So more than 45 countries have collaborated to put an end to tax avoidance strategies that exploit gaps and mismatches in tax rules. Say different countries have different tax rules, so they want to take advantage of the tax rules to that favor to avoid paying tax. The consequence of this is a multilateral instrument, which is an outcome of BEPS Action Plan 15. The BEPS initiative came out with 15 action plans, and one of that is the multilateral instrument. Under the multilateral instrument, today, India has entered into double tax avoidance agreements with more than 90 countries. So when you have any changes that you will have, then it needs to be all the treaties have to be amended. It has to go through the parliament and things like that. So to avoid that, the multilateral instrument allows governments to modify existing bilateral treaties in a synchronized and efficient manner, without the need to negotiate each treaty bilaterally. So instead of addressing each treaty, they look at the basket of treaties and then choose what is to be done. Now, this MLI has been ratified by the Indian government. So Indian government is a part of this 45 countries in OECD G20 inclusive framework. And Indian government has ratified multilateral instrument. It came into force from 1st of October 2019. And it is effective for 93 Indian bilateral DTAs. It applies for 93 double tax avoidance agreements. It applies to all the 93 bilateral agreements. Now, this Article 5 of the MLI is something which deals with elimination of double taxation. There were three options under this Article 5. One is options A and B is relating to exemption method, which India has not opted. Option C prescribes application of ordinary credit method. India has opted for ordinary credit method in its domestic laws in majority of its treaties. And so India has chosen to apply option C to all its covered tax agreements or double tax avoidance agreements. So consequent to this particular MLI, India's double tax avoidance agreements with Bulgaria, Egypt, Greece, and Slovak Republic contains exemption method. So it is to be replaced by credit method to that extent. So this is the impact of this multilateral instrument, which addresses how to implement elimination of double taxation in all the treaties. Now let us look at how this elimination of double taxation arises. How does double taxation arises in India? How it is eliminated? What is the methodology and how it is implemented? Now, all of us are fairly familiar with these two fundamental regulations, which is Section 4 and Section 5. Section 4 is the charge of income tax. So under this particular section, it says that every person has to pay income tax on the total income earned in the previous year. And in respect of income chargeable under this income tax can be collected either at source, which is TDS as it is called in India. Outside India, it is called as withholding tax, or it can be collected through payment of advance taxes. We have payment of advance taxes in India on 4 installments. So you can pay income tax. So essentially, Section 4 says every person in India has to pay income tax of the previous earned in the previous year on the total income. Now let us look at all of this bold highlighted portions. Person, as we all know, it includes an individual, HUF, company, firm, AOP, and a body of individuals, everybody else. Previous year is basically the financial year, means the income is earned. As Mr. Singh talked about, it is very important to understand what is this total income. So there is a definition of what this income is. And if you look at Section 5, it talks about the scope of total income. Now we are looking only at, there are 3 kinds of taxpayers in India. One is called a resident taxpayer, one is a non-resident, and then there is a resident but not ordinarily resident. Let us look at these 2 categories, which is predominant, resident and non-resident. In the case of a resident, Section 5, which describes the scope of total income, which is prescribed in Section 4. Section 4 says that total income is taxable. Now, what is this total income, which is defined in Section 5? It says what is received or deemed to be received in India, accrues or arises or deemed to accrue or arise in India, accrues or arises outside India. This is in the case of a resident, total income of a resident. Now, let us look at what is the total income of a non-resident. Total income of a non-resident includes A and B, does not include C, which is what is accrued outside India. So, a resident has to pay taxes in India on the global income. A non-resident has to pay taxes in India on the income which is earned in India. This is the fundamental difference. So to that extent, because India is taxing total income, there will be consequences of double taxation, particularly when the foreign source income, which is point C, which is foreign source income, which is accrued or arises outside India, is taxed outside India. This is the consequence of double taxation. Now, what is this foreign tax credit regime? So today, if you look at Section 4 and 5, there is no reference to elimination of double taxation. It only talks about the government, how it wants to collect taxes. Very clearly, Section 4 says total income. And in the case of resident, it is total income, basically means global income. Now, if you have to look at elimination of double taxation, we have to look at 2 other specific sections, which is Section 90 of the Income Tax Act and Section 91 of the Income Tax Act. There is also a Section 90A, which is not very relevant, so I'm not touching upon that. So under Section 90, basically it's a bilateral relief through a treaty. So India enters into various double tax avoidance agreements and various other agreements, not necessarily DTAs. So whatever is provided in the treaty should be given effect to. So and that is given by Section 90. And Section 91 is where there is no treaty to that extent. India unilaterally chooses to give tax credit to that extent. So these are the 2 methods of tax elimination in India, double tax elimination in India. Now let us look at Section 90. The title of this particular section is Agreement with Foreign Countries or Specified Territories. Now this particular Section 91 talks about 4 kinds of agreements. The first is for granting of relief in respect of income on which have been paid income tax in both the countries, in India as well as income tax outside India, or income tax chargeable under this act and under the corresponding law to that extent. So this is the first kind of an agreement The second agreement is something that many of us are very familiar with, what it is colloquially called as double tax avoidance agreement. It is technically called as avoidance of double taxation of income under this act and under the corresponding law in force in that country. This is what is called as a bilateral agreement because the terms are agreed. Some of the terms of this particular agreement is something which is negotiated and agreed between the competent authorities or the tax authorities of both the countries, and then it is presented to the respective legislatures for it to be given effect to. In India, for instance, if you enter into a double tax avoidance agreement, it needs to be gazetted, and once it is gazetted, it is coming into effect automatically to that extent. Whereas in the case of the budgets that we recently saw, a finance bill is introduced in the parliament. After both the houses of the parliament approves it, it becomes an act. Whereas in the case of a double tax avoidance agreement, you don't have to go through the process of going through a parliament for that. It needs to be gazetted to that extent. That is the process of how effect is given to a double tax avoidance agreement. The third and fourth kind of agreements are also important, but it is nothing to do with taxation. Basically, one is for exchange of information for prevention of evasion and avoidance of double taxation, avoidance of income tax, and for recovery of income tax. The section D is basically relevant when you have instances like Vijay Mallya or Nirav Modi and any of their assets outside India to be confiscated and things like that. So all of this, as I said earlier, it may by notification in the official gazette make such provisions as may be necessary for implementing the agreement. So section 90 basically talks about the central government, this is basically the CBDT, they may enter into an agreement with the government of any other country with a respective tax authority, and that may by notification in the official gazette make such provisions as may be necessary for implementing the agreement. Now, what happens when the central government has entered into an agreement and then in relation to the assessee to which such agreement applies, the provisions of this act, okay, it shall not apply. That is the fundamental rule. Then this Income Tax Act will not apply, except when the provisions of this act is beneficial to that assessee. That is the way you have to read this particular thing. It says the provisions of this act shall apply to that extent they are more beneficial. The way you read this is Income Tax Act will not apply when there is a double tax avoidance agreement. That's a fundamental rule. It will apply when the provisions of the domestic tax regulation, which is the Income Tax Act, is more beneficial than the provisions in the double tax avoidance agreement. The exception to this rule too is when GAR comes. In the case of a GAR, GAR overrides everybody. So GAR is something which overrides even a double tax avoidance agreement to that extent. So this is what is the provisions of section 90, which predominantly deals with the double tax avoidance agreements, and double provisions of the double tax avoidance agreements overrides the other provisions of the Income Tax Act. Now, section 91 is basically a unilateral tax credit or a double tax avoidance agreement unilateral. In summary, if a tax resident in India earns foreign source income from a non-DTA country and has paid income tax in that foreign country on that foreign source income, such tax resident shall be entitled to foreign tax credit in India at the income tax rate in India or the foreign country, whichever is lower. So similar to section 90, except 91 will come into play when India has when a tax resident earns income from a country where India does not have a double tax avoidance agreement. The number of such countries, of course, is very, very minuscule. Now, in all of this regulation that we're talking about, elimination of double taxation, it is always a resident who is entitled to a double tax credit or elimination, because only a resident pays taxation on global income. A non-resident does not pay income tax on global income in the residence country. So to that extent, it is always a resident that section 90 and 91 in particular will apply. Now, there are certain explanations which has been given, which is extremely important, particularly explanation 4. It gives what is the meaning of income tax. It says in relation to any country includes any excess profits tax or business profits tax charged on the profits by the government of any part of that country or a local authority in that country. So this is what they have given, what is the income tax, Indian income tax, what is the rate of tax, and things like that. So this is what section 90 and 91 is. Now, if I see, for instance, section 4 and 5, they talk about taxation, and section 90 and 91 to that extent talks about relief from double taxation. Now, so far, if you see, I see some conflicts in this. What is the conflict? Now, I see the conflict between section 4.5 and section 90.91. This is something that this webinar is something that it would have been very nice if there was a physical interaction, because this is something that I would have asked all of you to talk about. What is the conflict that I see, and do you see the same conflict? The conflict I see is section 4 and 5 talk about taxation. Very clearly it says if you're a tax resident, pay tax in India on your global income. It does not talk about any credit. Section 90 and 91 talks about elimination of double taxation. So to that extent, when you have two sets of sections 4 and 5 and another section 90 and 91, what overrides section 4 and 5? Just because there is a particular reference in section 90 which talks about saying that the provisions of this act shall apply to that extent they are more beneficial, does it mean that section 90 and also section 91 overrides section 4 and 5? This is a fundamental question in terms of a conflict. So this is something which was very nicely addressed in this particular case called Azadi Bachao Andolan. This was a case where at some point in time, there was this entity called Azadi Bachao Andolan, which is a NGO. They filed a litigation in India saying that the tax treaties are getting abused. Okay, so because of this particular case, things like treaty shopping and phrases like treaty shopping became more popular. So basically they said the India-Mauritius treaty is getting abused because people who are not residents of Mauritius, they are claiming tax benefits. This particular Mauritius treaty said the capital gains which is arising in India will be shifted to Mauritius if it is owned by a resident of Mauritius. So there was purportedly a great degree of misuse of the treaty to that extent. So this is where, in this context, there was a ruling which was given by the Delhi High Court, and it went to the Supreme Court. The Supreme Court, in this particular case, they made this observation relating to the conflict between section 4.5 and section 90 and 91. It says, I'm reproducing whatever the ruling is. The judicial consensus in India has been that section 90 is specifically intended to enable and empower the central government to issue a notification for implementation of the terms of a DTA, which is what section 90 1A2 talks about. When that happens, the provisions of such an agreement with respect to cases to which they apply would operate even if inconsistent with the provisions of the Income Tax Act. This is the first highlighted portion of this particular ruling. If it was not the intention of the legislature to make a departure from the general principle of chargeability, then there was no purpose in making those sections subject to the provisions of this act. So if you go back to this slide earlier, both sections 4 and 5 talks literally, it starts with subject to the provisions of the act. And basically what it says is, when it says subject to the provisions of the act, some other section in this particular act can override this. And that is what the Supreme Court is talking about. So this particular ruling removes the conflict between section 4 and 5 in terms of it addresses saying that there is no conflict because of this particular usage of the word subject to the provisions of the act. And it also says the very object of grafting the said two sections with the said clause, which is said two sections in section 4 and 5, with a said clause is to enable the central government to issue a notification, because this notification which was issued by the CBDT was challenged in this case. They said that it is to enable the central government to issue a notification towards the implementation of the terms of the TTAs which would automatically override the provisions of the Income Tax Act. So the consequence in India is you have section 4 and 5, which talks about taxability. Section 90 and 91 talks about elimination of double taxation. So to that extent, section 90 and 91 is more powerful to that extent of elimination. And DTAs, which are concluded in bilateral manner, would automatically override the provisions of the Income Tax Act, except in case where the provisions of the Income Tax Act is more beneficial to the resident. This is a fundamental principle which is extremely important. The second conflict that I see is variances amongst countries on sourcing rules. This is something which is unique to India, and that is the reason why I've chosen to address this particular conflict. Different countries have different sourcing rules. In India, source of income is not defined in the Income Tax Act. Basically, it says it generally refers to generation of income in a particular jurisdiction and its taxation. According to sourcing rules, income is taxed in the country where it is earned. Now, all over the world, we have two kinds of taxes. One is what is called as the direct taxes, which is predominantly income tax, and the other one is indirect taxes, which is your transaction taxes, such as sales tax, VAT, consumption tax, GST. All of these are transaction taxes. The sourcing rules for direct tax is completely different from the sourcing rules for indirect taxes. In the case of income tax, income is taxed in the hands of the earner of income. Whoever earns income is liable to pay taxes, and income is earned and it is taxed in the location where it is earned. So under the Income Tax Act, income tax is levied on the person who earns the income in the location where it is earned. In the case of transaction taxes, it is the opposite. Transaction taxes, it is imposed on the person who consumes the transaction or uses the transaction to that extent, and it is always imposed on the person who consumes the transaction. So that is why it is a transaction tax. Transaction tax is always paid by the last person who uses a transaction tax. So these are the fundamental rules that we have in income tax and transaction tax. Now we have this unique section 917 in India, which talks about fees for technical services. There's a lot of confusion which is created by this section, and a lot of people address this issue. They don't know how to address. So that is the reason why I've chosen to specifically address this. It means any consideration. This is a definition under section 917. It says any consideration, including lump sum consideration for the rendering of any managerial, technical, or consultancy services, including the provision of services of technical or other persons. This is the definition. Now, further 917 says, it shall be deemed to accrue or arise in India if it is payable by a person who is a resident, except if the services are utilized outside India, and if it is payable by a person who is a non-resident, if the services are utilized in India. So this is the provisions of FTS, which many of you may be aware of. Now, what this means is the situs of the payer. That is basically because if you see this, it says it is taxable, it is accruing in India if it is payable by a person who is a resident. So it is the situs of the payer and the situs of the utilization of services. So if you go back, it says FTS shall be deemed to accrue or arise in India if it is payable by a person who is non-resident, but if the services are utilized in India. So this would mean that the situs of the payer and the situs of the utilization of services will determine the tax jurisdiction for the purposes of taxability of FTS in India, irrespective of the situs of services, subject to any beneficial provisions of a DTA. So basically, if you see FTS, the concept of which is prevalent in indirect taxes and transaction taxes is imposed on income tax. So because of which the earner is not supposed to pay taxes in India. A person who is a resident, if he's making the payment, that income is supposed to accrue in India, or if it is utilized in India, is supposed to accrue in India. So the conflict which arises in this case is, let us take, for instance, in the case of US. In the US and many other countries, the general, including in India, the general rule for sourcing personal services income is the place of performance of services. So what happens in this kind of situation? Let us take, for instance, I'm an international tax consultant. I provide services from India to a client in the United States. The income accrues to India because I'm rendering those services from India. When I render those services, the income is not earned outside India. So any country to whom I provide services, they don't do any withholding taxes. But take the reverse situation. If there is somebody outside India who's providing services in the nature of a managerial, technical, or consultancy nature, India says that income is, since it is consumed in India or services are utilized in India, the accrual happens in India. So to that extent, you pay taxes in India, and we have to take a withholding tax in India. So this particular income gets accrued in two countries. In the domestic country because it is rendered there, and in India because it is utilized there. So this is where the conflict is, and how does this get resolved? Whatever tax which is getting withheld in India may not be eligible for foreign tax credit because the foreign country says it is not accrued outside India, it is accrued outside that country, it is accrued in that particular country. The residence of the recipient of the service in place of contracting under the time of are irrelevant in India. This is particularly resolved through the DTA provisions. This dual residence conflict is resolved by para 7A of Article 12, particularly of India-US treaty. But this particular clause is there in all the major treaties that India has concluded. Royalties and fees for included services, the terminology may change between the treaties, shall be deemed, this is according to the treaty, shall be deemed to arise in India in a contracting state when the payer is a resident of that state. So to that extent, this conflict gets recognized because the DTAA says if it is paid by a resident of that state, then that particular foreign fees for technical services shall be deemed to arise in that particular state. So in the example I talked about, particularly in the United States, whatever accrues in that country gets nullified and is deemed to accrue in India. So to that extent, you will be able to get a double tax credit to that extent. But the practicality of this particular problem does not end. So today what is happening is India has chosen to apply a certain principle which is contrary to what the world does, and it is also provided relief under the treaty. So when we negotiate a contract with any person outside India, if we are going to tell them saying that, see, this particular thing, whenever I'm making a payment, I have to withhold taxes at a particular rate. So whatever you want to get is net of withholding tax, but you can take a credit in your country because the treaty provides for that. Those people are not willing to enter into a contract on similar terms because they find it a little, to use a very bad word, I think they find it ridiculous that we have a regulation like this in India. So they very clearly say, you may have a regulation in India for whatever it is. I am not concerned about it. I don't want to take any tax credit in this country. Whatever is the terms of the contract is what I need to be paid. I don't want to go through the administrative rigmarole of applying for a tax credit. I don't know whether I will get the tax credit or not. More than anything, people are not willing to go through this process because it affects their cash flow. To the extent of tax withholding in India, they're going to get lesser amount of whatever the agreed amount is. So to that extent, they don't want to do. The consequence of this is basically the cost of transaction cost goes up because people have to gross up that amount and pay withholding tax on that grossed up amount. So these are the variances that we have between in the case of sourcing rules relating to double taxation. Now let us look at, if you look at section 90 and section 91, okay, it does not talk about how it is implemented in India. Today, they are talking about ordinary credit mechanism, as we have seen in section 90 and 91. So when they are talking about ordinary credit mechanism, because we are taxing worldwide income, till 2017, there was no regulations in this country how to compute foreign tax credit. So that created a whole lot of confusion because the tax authorities did not know how to do it, the taxpayers did not know how to do it, and in some instances, it also resulted in litigation. People didn't know whether you will take a credit on a country by country basis or on a pooling method. And even within a country basis, whether you have to do it on a source by source basis or similar methodologies, people didn't know about carryover of excess tax credits. So there was utter confusion. It was finally in 2017 that the foreign tax credit rules came into force. Since it is foreign tax credit rules, there is no reference to exemption method. India does not follow the exemption method. It follows the ordinary credit rules. Now, there are a few subsections in this. So the first one is basically a resident shall be allowed a credit for any foreign tax paid by him in a country or specified territory outside India. So basically it talks about a credit of the amount of foreign tax. When we're talking about credit, it is not an expense reduction. It is a reduction from the Indian income tax payable on foreign source income, on global income, and reduction of tax paid on the foreign source income. And this happens in which year? It happens in the year in which the income corresponding to such tax has been offered to tax. So there has to be a correlation between the tax paid and the income. In case where income on which foreign tax has been paid or deducted is offered to tax in more than 1 year, then it shall be split across those years in the ratio in which it is offered. So foreign tax credit will be allowed in the ratio in which the income is distributed between these two assessment years. The next issue is the foreign tax. What is this foreign tax? It basically talks about the tax covered under the said agreement. In all the double tax avoidance agreements, Article 2 talks about what is the scope of the taxes covered. So the FTC rules says that it refers to the whatever tax is covered under is defined under the DTAA will be eligible for credit. This is a very, very important point. So I'm repeating it. When you're talking about foreign tax, it is basically the tax which is covered in the agreement, not the tax that is paid in a foreign country. That is very, very important. Now, in the case of Section 91, it talks about tax payable under the law in force in that country or specified territory, because there is no document like a double tax avoidance agreement. So it talks about whatever taxes that you have paid outside India is eligible for tax credit in India. Whereas if you look at Section 90 in particular, whatever tax is defined in the DTA shall be eligible for credit. Now, the credit under sub-rule 1, basically what does it include? It includes tax, surcharge, and cess, but it does not include interest, fee, and penalty rightfully. Now, no credit shall be eligible in terms of a foreign tax which is disputed. So let us assume for a moment that a taxpayer has paid a certain amount of tax, and then the tax authorities in those countries don't agree on that amount of taxes. They want you to pay more. So to that extent, if there is a dispute, that disputed tax will not be eligible for foreign tax credit unless the dispute is settled. Because it can result in a situation where you are given a tax credit in India and the dispute is settled in your favor, and then the amount of taxes is refunded outside India. Then to that extent, you will be a double beneficiary. So to avoid that, if there is a dispute, such taxes are not eligible for tax credit. You can take a credit of such disputed tax in the year in which such income is finally settled to that extent, and it has to be done within a period of 6 months. Now, FTC, what is this FTC, foreign tax credit? It is basically the aggregate of the amounts of credit computed separately for each source of income arising from a particular country or specified territory outside India. I'm repeating. So in the case of foreign tax credit rules, they are saying that it is a source by source credit. There are two kinds of credits in the world for foreign tax credit. One is called a pooling method. You aggregate all the amount of taxes paid outside India, and then you see whatever the rate, because the treaty says whichever rate is lower, you will take a credit. So they will compare what is the total amount of taxes paid, what is the effective tax rate in the foreign country, what is the effective tax rate in the domestic country, and whichever is lower, you will get that benefit. Whereas India says the aggregate will be computed separately for each source of income. Say, for instance, if you have dividend income, you have to see what is the amount of foreign tax credit on dividend income. On interest income, you have to separately take. For capital gains, you have to take separately. For salary, you have to take separately. Like that, you have different sources of income. You have to compute separately. And then if there is a foreign tax credit which exceeds the amount of tax payable, let us assume that the amount of taxes that are paid outside India is higher than the amount of taxes paid in India, then whatever taxes that are paid outside India, that excess is something which is to be ignored for the purposes of this particular clause. This also has an impact which we will evaluate later. Now, if any of the tax is payable under AMT, the credit shall also be allowed to that extent of like a similar credit for normal income. And there is a methodology of conversion of currency to that extent. And if you see 7, 8, 9, basically the methodology of how it is to be taken credit, the process of taking credit, which is by filing form 67. Now, let us look at a practical situation of foreign tax credit in India. This is something which is important because we need to see how it works. Now, foreign tax credit rules. It provides that the foreign tax credit shall be the aggregate of the amounts of credit computed separately. I'm repeating what has been said earlier. For each source of income arising from a particular country or specified territory outside India. So there is no pooling of all the income. Say, let us, for instance, take a company like Infosys, where I used to work. They used to operate in 30 countries. Different countries have different tax rates. So to that extent, you can't take a pooling of all the taxes paid in all those jurisdictions and then determine an effective tax rate and compare it against the effective tax rate in India. It can't be done in that manner. It needs to be done first on a country by country basis and within each country for each source. After that, the credit shall be the lower of the tax payable under the Act on such income, on such foreign source income, and the foreign tax paid on such income. And as I said, the excess taxes, it cannot be given effect to, it is to be ignored. So what is the consequence of this? There is no mechanism to offset a high tax income and a low tax income from a foreign country. For instance, capital gains, you take always has a lower rate of tax all over the world. Other income has a higher higher rate of tax. There may be some specific items of income which may be subject to a specific rate of tax, which may be high or low. So you will have different rates applicable to different kinds of income. So you can't combine a high tax income and a low tax income because India is adopting a source by source principle. Next, the corporate income tax paid in a foreign country under a higher rate, which I talked about when you are talking of a multinational company, particularly the Indian IT sector where they operate in multiple countries, where you have countries with high rates and low rates, you can't combine them. So what is the impact? Let us look at the impact when we compute separately for each source of income from a particular country, not even from a pool of countries. So different sources of income from the same country. Let us take this simple example where an Indian company earns royalty income of $200 from country X. Everything is country X because it is from the same country. So they earn royalty income of $200. They earn business profits of $300. And there's a dividend income from its subsidiary in country X of $100. So that means the parent company is getting $100 of dividend income from its subsidiary, which is a foreign country. Okay. And then the other issue that I want to talk about in the case of foreign tax credit is, particularly in a corporate context, it will apply only if a company is operating on a branch mode. If it is operating on a subsidiary mode, foreign tax credit will not come into play because they are two different entities. Foreign tax credit will come only if the same person, which is a branch, is basically an extension of the same company. It is an extension of the head office in a different country. And that is the reason why, in the context of a company, foreign tax credit will come only if a company operates on a branch mode. It will not come into play when the company is operating on a subsidiary mode. This is a fundamental rule. So in this particular case, the Indian company A earns income from its branch outside India in a particular country. So to that extent, there is a dividend income. Dividend income essentially basically means excess business profits tax which is given. And they earn $300 of net income. This is separately computed for each country to that extent. Now, country X it levies, let us assume, 15% withholding tax on royalty and dividend payment, and the business profits of the branch are taxed at 40%. So if you look at the mathematics of this, company A is subject to foreign tax of $30 on royalty income, which is 15% into $200. $120 on business profits, which is 40% into $300 of business profits, and $15 on dividend income, which is 15% on $100 of dividends. So this results in an effective tax rate of 27.5%, which is 165 divided by $600 on foreign source income. Corporate income tax is assumed to be 35%. There was a situation in the past where it was 35%. Now it has changed, but let us assume for the purpose of understanding that it is 35%. So Indian tax liability on foreign source income is $200. $600 you have earned from outside India, on which you are supposed to pay 35% in India. So there is a $210 liability in India on foreign source income, of which already $165 of foreign tax is paid outside India. Under the pooling method, you will get a full $165 of credit because $165 is lesser than $210, which is essentially 27.5% of foreign tax is lesser than 35% of foreign tax rate. This is simple so far as pooling method is concerned. In this case, you have pooled all the income, you have computed the income tax on the pooled income, and then you have determined this rate. Now, if you're going to source this on a source by source principle, let us see if foreign tax credit is computed separately for each source of income. Now, in the case of royalty income, we have seen foreign tax is going to be $30, basically because $200 of royalty income into 15%, actual foreign tax is $30. On that foreign royalty income of $200, the tax payable in India is $70. So you have a source limitation. You have either get $70 of credit or $30, whichever is lower. So you have a source limitation of $30. You can't take a credit of more than $30, which is fine because you have only paid $30. In the case of business profits, actual profit is $300. The tax paid is $300 into 40%, foreign tax is 120, whereas the domestic tax on foreign business income is 35%, so it comes to $105. So you will be able to take a tax credit only to that extent of $105 because it is an ordinary credit method. You can't take $120, it is restricted to $105. And in the case of dividend income, like royalty income, the actual foreign tax paid is lower, so you will get a limit, you will get a credit of $15. So if you total up this total amount of foreign tax, which is on the right-hand side, you will get 30 plus 105, 135 plus 15, $150 of foreign tax credit you are eligible for under the source by source. Whereas if it is under the pooling method, it's 165. This is the impact of using a source by source principle. Now, foreign tax of $165 paid on foreign source income of $600 results in an effective tax rate of 27%, whereas tax liability tax rate in India is 35%. So tax liability is $210. If it is computed separately, you will get only $150, whereas it is under a pooling method, you will get a higher credit to that extent. Now you will have the difference that you have between these two methodologies is ideally 165 should be allowed because the rate in India is higher than the foreign tax rate. So 165 should be allowed, which will be allowed under the pooling method. Because we are going through a source by source limitation, it is restricted to 150 because the excess tax paid in the case of business profits of $15 is not allowed to that extent. So that is what is called as an excess tax. The excess foreign tax of 115 is to be ignored because the foreign tax regulations say very clearly that it is to be ignored. It cannot be carried forward to future years to be set off against domestic tax liability on foreign source income. We will evaluate this a little more in detail. Okay, so what is the consequence of all of this? The pooling of different types of income will result in adding high tax income on low tax income, thereby increasing the amount of creditable foreign taxes available for tax set-off. Okay, the total liability of our company A will be lower at 110 under the pooling method as compared to the total tax liability of $225 under the source by source limitation. This is the impact of the source by source regulations to that extent. Now, let us look at this neighboring countries, Singapore. They also used to follow a source by source principle at one point in time, country by country, source by source. Okay, they shifted that in the year 2012. They introduced a new FTC pooling system. So they said they gave an option to the taxpayers to either pool the foreign taxes or they use it under the source by source method. But if they choose to go under the pooling method, they had to meet certain conditions where they said income tax must have been paid on the foreign income. Second thing is the headline rate for the foreign jurisdiction from which the income is derived should be at least 15%. Today, in the future, 15% is going to perhaps become the minimum corporate tax rate because of the BEPS regulations and things like that. And there must be Singapore tax payable on this. So a country like Singapore, of course, is a smaller country, but they chose to move away, give an option of source by source or a pooling system, which unfortunately is not available in India. India should follow a worldwide pooling method because a large number of Indian companies, particularly from the IT sector, operate in foreign countries through a branch structure. And by following a pooling method, what is very important is India will still not give more foreign tax credit than is payable on that income. If you see in the example that we talked about, still there is a certain amount of taxes which is payable in India. They are not losing anything by following a pooling method. It will make life easier for a large number of foreign Indian companies operating in a large number of foreign countries. Now, let us look at one more concept. I have another 5 to 10 more minutes, I suppose, Nagarjun.
Yes, sir.
Okay. So this is a very, very important concept that I want to touch upon. The impact of this carry forward of excess foreign tax credit. Today in India, we are all very, very familiar with this concept called carryover of losses. If you have business losses, you carry over losses to be offset in the future years. If you have capital gains, you also have principles for carryover of capital losses to be offset against capital gains. There also you have certain rules for short-term against short-term, long-term against long-term, short-term against, you have certain rules for carryover. Like that, many countries also have carry forward of excess foreign tax paid. What is this excess foreign tax paid? According to the FTC rules that we saw earlier, it says where in India, where the foreign tax paid exceeds the amount of tax payable in accordance with the provisions of the agreement for relief or avoidance of double taxation, such excess shall be ignored for the purposes of this clause. This is what the foreign tax credit regulations talks about. We also have seen in the previous example, $15 of excess foreign tax credit has to be lapsed. It cannot be carried forward. Companies that do not receive full credits for taxes paid in foreign countries are said to be in excess credits. That is the terminology which is used. Countries which have got excess credits for taxes paid are said to be in excess credits. Excess credits could arise. How does this excess credits arise? As we have seen in the previous example, if the ratio of high tax income or the ratio of income from a high tax country during a financial year is high. In the previous example, we saw that the high tax income in the nature of business profits is high. Excess credits can also arise if a multinational company is carrying on a business in a portfolio of countries where the income tax rate is higher than the income tax rate in the residence country, or has incurred losses in the residence country. This is a very, very important point. And you have a concept called branch profits tax in the United States in particular. A branch profit tax is something similar to a dividend tax. This needs to be computed on a yearly basis on a numerical formula. And if that formula results in payment of a particular branch profit tax, we need to pay branch profit tax in addition to the income tax payable. When you talk about a branch profit tax, basically it arises when the amount of business on the profits which is generated from the foreign country over a period of time decreases. So you have these three circumstances under which you will have excess credits. Many countries permit carry back and carry forward of excess credits, which we will look at. Now let us look at a practical situation like this where a company has incurred losses in the residence country. there was this very beautiful issue that a public sector company in India faced, which is Bank of India. So this Bank of India, generally, if you see branches in India, the Indian IT companies has chosen to operate predominantly through a branch structure. It could be a Infosys, Wipro, TCS, whoever. Many of them operate on a branch basis. But other than the IT sector, the banks and the insurance companies generally operate on a branch basis. So in this particular case, Bank of India, they had in the financial year 2011 and 12, because that is the issue which has been addressed to in a litigation, they had losses in India. They used to operate in many countries outside India on a branch structure. So what had happened is they had losses in India on a global basis, but they had paid taxes outside India to a significant amount. So they applied for a credit. They sought a credit for taxes paid outside India on a double tax basis. So income tax authority very clearly said there is no double taxation because the company has filed for a loss return in India. So there is no double taxation. You are not paying any taxes in India. So how can you claim a refund of taxes paid outside India? Which is a very relevant point, because the company has not paid there's no tax payable in India because it's a loss return that they have filed. So the company said, and then of course, whatever is the losses, the net losses that they had, they had a net loss of somewhere around about 175 to 200 crores of net losses they had. The gross losses was 800 crores. They had a foreign income of about 600 crores, and then it resulted somewhere around 200 crores of losses. So the company was permitted to carry over the losses to be offset in the future years. So the Bank of India said, see, you can't say that I have not paid taxes in India because my losses in India is 800 crores. You are not allowing me to carry over 800 crores. You are allowing me to carry over only the net losses because you have offset the profits that I have earned outside India. Because you are offsetting the profits, indirectly I'm paying taxes in India on that income. So either you give me a gross loss of 800 crores to be carried forward, or you refund the amount of taxes that I paid outside India, and to that extent. So the tax authority said, because you have not paid taxes in India, you can't take a foreign tax credit. Okay, that is one. Second thing, they said the tax regulations do not allow you to carry over gross losses. It only allows you to carry over net losses. So to that extent, we don't have a relief to that extent. So this is the ruling which was given while the income tax authorities refused it when it went to ITAT. The Bombay ITAT tribunal, Mr. Pramod Kumar, who was the VP of ITAT at that point in time, gave the ruling. Incidentally, he's a chartered accountant. He said that you are not entitled to credit basically because of this. But he made an indirect reference saying that, fortunately for them, the ITAT tribunal allowed them to take a deduction of foreign taxes in its income tax return. So to that extent, the relief was mitigated to that extent of tax rate in India, but they didn't get the full tax credit of tax paid. But he made a reference saying that, unfortunately, you have to look at alternatives to do it. So now let us assume that, for instance, there was this issue of carry forward of excess foreign tax paid because the taxes was not credited in India. Whatever taxes that they paid on the 600 crores of foreign income, they could have carried it forward, and whenever the company became profitable, they could have adjusted that. But unfortunately, this carry forward of excess foreign tax credit is not addressed at all in the foreign tax regulations in India. These are all the countries which permit you to carry back and carry forward excess foreign tax to that extent. India should permit. It was my suggestion when I made this proposal almost a decade back, saying India should permit carry forward of excess credits for 10 years so that Indian companies can take credit in future years if the revenue from the portfolio of countries change. Or if the Indian company is unable to take credit during a year, they should be given choice to take a deduction, as is the practice in many countries. Fortunately, in the case of Bank of India, the tribunal gave them the benefit of taking deduction. But this is also something where if a company is unable to take credit even after the carryover of excess foreign tax credit, in the final year, they should be given a credit, as is a practice in many countries. This is something which is useful, and the country is not losing because of that, because they are only giving credit to that extent of excess foreign tax credits, which is anyway lower to that extent of tax rate in India. Okay, so Nagarjun, I can finish my presentation here, depending on how many questions. Otherwise, I can continue maybe for another 10-15 minutes, if you permit.
Sir, we have about 20 questions. I have
ahead.
summarized the questions to about 12 to 13.
Okay, so let's go ahead.
Yeah, please go ahead. You want to take the questions or to continue the presentation, sir?
No, I will. If I continue my
But
presentation,
Krishnan, I mean, your slides have many issues which may be, I mean, in one of the questions, because foreign, eligibility criteria, the things or the state taxes. So if you can finish, I mean, those cases, you may be covering many of the questions.
Okay, then I will take another 10 more minutes.
10 minutes,
10
and then we can go to the questions.
Yes. So I will take this particular issue about one particular issue, which is state regional taxes paid in a treaty country eligible for foreign tax credit in India.
Yes,
so this is something which is unique. Okay, so let me quickly go through this process. Foreign taxes eligible for credit. Basically, different countries have different tax systems to compute and pay income tax. In India, there is fortunately only one income tax which is paid to the government of India. There is a mechanism of sharing that revenue with the states. Some countries follow a federal and regional structure to impose income tax. Today, many of you are very familiar with the tax regulations in the United States. So there you have a federal and a state and a city tax structure. So let us look at the consequences of this. Now, income tax in Switzerland, it is levied at a federal level and by the cantons. When you talk about a canton, it is basically a state. And based on the laws of their canton, the communes also pay income tax. When you talk about communes, it's basically cities. So in Switzerland, you have a federal tax, you have a central tax, you have a state tax, and you have a city tax, which is what is called as a canton and communal tax. The federal tax is identical for all its territories. Now, if you look at particularly, as I said earlier, Article 2 in all the treaties that India has concluded, it basically covers what is called as taxes. Okay, so taxes covered is the title of this Article 2 in all the treaties. Earlier, when we looked at Section 90, I highlighted a particular point, okay, which says in the case of a treaty, whatever credit that you can take is what is defined in the treaty. Whereas in the case of Section 91, I had highlighted saying that whatever taxes is paid outside the country, out in a foreign country, is eligible for foreign tax credit under Section 91, whereas under Section 90, it is basically what is defined under the treaty. And that is the reason why Article 2, which is taxes covered, is very important. And in the case of Article 2 of the India-Switzerland Treaty, it says the taxes to which this agreement shall apply in the case of Switzerland are federal, cantonal, and communal taxes on income. Okay, so total income, earned income, this is what it is. Since the treaty definition includes cantonal and communal taxes, whatever taxes are paid at cantonal and communal level are eligible for foreign tax credit in India. This is a simple principle. Now let us look at one more country, which is Germany. There again, you have a corporate tax rate which was at 15%, and there's also something called as a solidarity tax, which is basically payable. This is basically a municipal tax, which is also there. So as per Article 2 of the India-Germany DTAA, this agreement shall apply to taxes on income and on capital imposed on behalf of a contracting state, of a land, or a political subdivision or local authority. So as I said, this solidarity charge is something which is charged by a municipal trade tax, is a municipal trade tax. So to that extent, because it is a political subdivision, whatever municipal taxes that you pay, which is called the municipal trade tax, that is also eligible for tax credit under the treaty. as the scope of taxes covered under the India-Germany Treaty includes taxes on income imposed by political subdivision and is eligible. Singapore, cantonal taxes, communal taxes eligible for credit. In Germany, municipal trade tax is eligible for credit because it is defined in Article 2. Now let us look at this great country called the United States. As I said, you have in the United States, you have federal tax, you have state tax, and you also have city tax. So Article 2, in the case of US DTAA, talks saying that existing taxes in the United States to which this convention shall apply are federal income taxes imposed by the Internal Revenue Code. Consequently, whatever state taxes and city taxes that you pay in the United States will not be eligible for foreign tax credit in India. Let us look at one more country, which is Canada. Again, here you have a provincial and territorial taxes in Canada, similar to states and cities. So corporations and permanent establishment have to pay provincial and territorial tax. If you look at Article 2, existing taxes in Canada to which this agreement shall apply are the taxes imposed under the income tax of Canada. And when you're talking about income tax of Canada, it does not include the provincial and territorial income tax. So you are not able to take tax credit of a provincial basis. So as a taxpayer, what happens is our overall tax liability will increase because of our inability to take credit in India from some portion of foreign taxes paid. So the issue that we have here is because the DTAAs are not consistently concluded amongst the countries, you will have situations where in some countries, unfortunately for us, the trade that we have with the United States is extremely large, and because of which the loss of tax credit to that extent of taxes paid in cities and states will also get lapsed. And there is inconsistency between the conclusion of the agreements to that extent. Whereas under Section 91, which is of course minuscule because the number of countries that India has not concluded DTAs is very limited, there you get a tax credit on the total taxes paid. Okay. Section 91 basically says Section 91 does not distinguish between state and federal taxes eligible for foreign tax credit because this is what it says. Now, I want to look at one particular decision in the case of Tata Sons Limited. I'm referring to Tata Sons Limited because at the time when this issue was there, they were not a listed company. They were Tata Sons was not a listed company. Tata Sons was Tata Consultancy Services was not a listed company. It was a division of Tata Sons, and this was in relation to Tata Consultancy Services, which is a software company, as it was called now. It is called an IT company, a contemporary of Infosys and Wipro during that time. This is a beautiful ruling given by again Mr. Pramod Kumar, Vice President of ITAT, who is incidentally a chartered accountant. This is a very unique case because let us look at the facts of the case briefly. Tata Sons had sought double tax relief in respect of income tax paid in various states in US and Canada, even though the Indo-US and India-Canada treaties do not allow such credit, and a claim for deduction under 37(1) as an expense claim was declined by the Mumbai ITAT. Just to give a brief background of this company, first, they applied for a foreign tax credit, first, for all the taxes paid outside India, both state and federal. Second, in addition to taking foreign tax credit, they also deducted the tax paid outside India as an expense. So they did a double deduction. So the ITAT first it said, you can't take a deduction because income tax is not eligible for deduction as an expense. So they did not allow expense as a deduction. Second thing, they disallowed foreign tax credit, basically because they said state taxes are not allowed because the treaty does not recognize state taxes as income tax, so you can't get a credit. This was the original ruling given. If you see this ruling, it was given in February 2011. That original ruling was given in November 2010, which is about 4 months before. This Mumbai ITAT, they recalled the earlier ruling. And they have made some very important observations, and that is why this is something which is a very well-considered ruling. And it's very important for all of you to look at this ruling. The observation, the final observation they said is, in our considered view, it is indeed an incongruous position that payment of state income taxes in US and Canada are not allowed deduction from income. They are not given credit because they are treated as income tax in terms of things. These are treated as income tax in terms of the provisions of the domestic tax law in India. And these payments are also not being considered for granting credit for taxes paid abroad by the SSC, since only federal income tax is eligible for tax credit in terms of the Indo-US, Indo-Canada treaty. So essentially, see, the third point is a very, very valid point they're talking about. They're saying there cannot obviously be a tax payment which is neither treated as admissible expenditure. In one case, we are saying it is an income tax, so you can't take a deduction. On the other hand, we are saying you can't take a credit because it is not income tax under the treaty. For expense deduction, you are taking a particular option. For credit, you are saying you are treating it differently because it is not defined under the treaty, because of which you are in a double jeopardy. You are not able to get both the benefit to that extent. This is a very nice summary of that particular issue. So he says we are alive to the fact that Section 91 refers to a situation in which the assessee has paid tax in any country in which there is no agreement under Section 90. So basically what they're saying is Section 91 allows you to pay taxes on foreign income tax, because there's no definition of foreign income tax under Section 91, unlike in the case of the treaty, because you have a definition for income tax under the treaty. So Section 91 and Section 90 itself, there is a conflict, particularly where state taxes are not allowed today. So they are saying though Section 91 applies only to a case where there is no DTAA, a literal interpretation would result in a situation where an assessee will be worse off as a result of the provisions of the DTAA, which is not permissible under the Act. So Section 91 must consequently be treated as general in application and must prevail. So they say accordingly, even an assessee covered by the scope of the DTAA should be eligible for credit of state taxes under Section 91, despite the DTAA not providing for the same. So they are saying Section 91, Rule 1 is it will apply if there is no DTAA. But this particular ruling saying that even if there is a DTAA, if there is an incongruence between Section 90 and 91, then 91 you should be able to take state tax credit. So they said you should be allowed to. This became a de facto rule based on this, because this particular ruling was not contested. Now, of course, they said, as is a scheme of tax credit envisaged in Section 91, tax credit in respect of foreign income tax is restricted to actual income tax liability, or which in respect of which. So if the combined taxes of federal and state taxes is higher than the country tax, India's tax rate, then to that extent, the excess tax credit will be lapsed as per the rules. This is what is the ruling, which has become more or less de facto, because many of the companies started taking, whoever was eligible for foreign tax credit, they were considering state taxes under Section 91. So you had a unique situation where you used to take credit under Section 90 under the DTA for federal income tax, and credit under Section 91 despite there being a DTA to that extent. Now let us look at this particular situation. What happens now after the FTC rules have come? The FTC rules specifically says foreign tax referred to in Rule Sub 1, okay, mean in respect of a country or a specified territory outside India, tax covered under the said agreement, which means again you'll go back to Article 2 of all the treaties, and under Section 91 it says tax payable under the law in force in that country. So that means you'll get a 4. So the question which I don't have an answer is, the FTC rules was introduced in 2017 while the ITAT ruling was in 2011. What happens to state tax credit? The FTC rules unfortunately have not recognized the impact of this particular ruling while framing the rules, and to that extent, they have not given credit to the state income taxes paid. There's only one observation that I had was when I made my presentation to the Committee for Foreign Tax Credit, this issue was something that I specifically addressed.
And one of the members came back and said that if you're going to do whatever you are suggesting, then whatever has been agreed in the treaty will be dishonored. So to that extent, we can't implement all of those things. See, today, for instance, if you based on this particular ruling, there have been many companies who have been able to take tax credit despite the DTA not permitting or not recognizing state taxes as an income tax. Despite that, India has given credit, and US has had no problems about India giving credit because it doesn't affect them. So it would have been very, very appropriate if the state taxes also was included for foreign tax credit in India. With this, I conclude. Thank you very much for giving me that extra time for discussing this particular case law.
Thanks. Thanks a lot, sir. Thanks for sharing that valuable insights in a very, very simple manner. It was very simple explanation, and the way it was presented with the ease, what you have presented, it's really admirable, sir. Thank you for such a valuable insight session.
Krishnanji, you can stop sharing.
I will.
I'm sure this is a very complicated topic as such, foreign tax credits for many of them, but with a very simple explanation what sir has given, I'm sure many have fallen in love with this topic, and will definitely feel that many will do a deep dive into this subject. I know many of you may not have got the answers for your questions while going through the webinar presentation, but due to paucity of time, we should have we had to cut short the topics which could be covered. The chosen topic was introduction and intricacies of foreign tax credit. Definitely, the purpose is served. We got the detailed explanation of the introduction and certain nuances in the foreign tax credit area. With this, sir, can we go for the questions?
Sure.
Yeah. Many of your questions have been addressed in the PPT, definitely. For information of the members, yes, we will share the PPT if requested in writing a mail to dtc@ica.in. We will definitely share the PPT. So you will get the most of your answers which are covered in the PPT. Which are not covered in the PPT, we will take up now. One is, sir, when there is different tax period between the source country and the in India, when there is different tax period, how to take the credit?
Proportionate basis. Because the foreign tax credit very clearly says, the rule says very clearly, take proportionate credit. So, for instance, this happens largely with the United States, because they follow a calendar year, we follow a fiscal year. Okay, so whichever is the major portion of that year which is covered in the particular assessment in the previous year, you take it. So, for instance, we follow April to March. So, whatever is the period of April to December, cover it in the year in which that April to March happens. So you will have a lag of maybe a certain period, because April to March happens after the calendar year to that extent. So you have to defer the tax credit to that extent. So what does the FTC rule says? You offer to tax. So today, when you have a double tax income, you will offer to tax. So how will you determine what is the double tax income? Either you choose to take the entire income that you have got in a previous calendar year, because you're taking credit in India, if you're a tax resident, you take the entire calendar year's income in one particular year and the entire calendar year's tax in that particular income, in that particular year. This is a practical approach. So take, for instance, in 2019, by 2019, you take 2023. 2023 is a year which has passed. 2023 is a calendar year in which you would have paid taxes in 2024 April. If you have to take a credit, you have to take a credit in financial year 24-25, because 24-25 will come only after 23. So what you have to do is, in 24-25, you take the entire income
and then take the credit to that extent because the larger portion falls in that year. If you choose to take on a proportionate basis, then take April to December in 1 year and January to March in 1 year, and proportionately you take the tax credit to that extent. So split the income and the tax in a proportionate manner in whichever year it is. This is a practical solution, but we don't know whether this will be contested. But I think more or less the tax authority should be able to take that position.
Okay.
But having said this, unlike in India, the United States allow you to change your assessment year. So you can choose to take an April to March. So supposing if you have consistent issues like this, you may choose to pay taxes in the United States on April to March basis so that you synchronize. And this is what I advise to people who are called dual tax residents. See, today US is the only country, I can say, large country which taxes its citizens. So if US citizens particularly are staying in India, they become tax resident in India because of substantial presence in India. They become a tax resident in the United States because they are a US citizen. So they become a dual tax resident. So depending on what is the income that they have, they may have to take foreign tax credit in both the countries if they have a foreign source income. So under the circumstances, for such people, it may be useful for them to consider changing their calendar year to a fiscal year for synchronization.
Okay, thank you very much, sir. The next question is, when there is a loss by the Indian company and there is a withholding tax in the foreign country, how to take the credit of such withholding tax in India?
Will not get it because that is what, unfortunately, India does not allow excess tax credits. And this particular case, whoever has asked this question, please refer to this Bank of India case, which was settled, the ruling was given in 2021. It's a very fine case. Unfortunately, because the FTC regulations do not consider the concept of excess tax credits, you will not be able to get tax credit, and you will also not get that whatever carryover losses that you will have, it will be on a net basis, it will not be on a gross basis. My sympathy is to you because the regulations do not consider that.
Then, how to convert the foreign currency tax into INR, sir? What is the rate to be?
The foreign tax regulations provide that option of doing it on a monthly basis on the previous month's rates.
Previous month's rate.
So foreign tax, I can upload that presentation if you wish. So this particular, it talks about it. Just give me a second.
Yeah.
Is this presentation visible? No. Okay, 1 second.
Not yet. Not yet.
Okay. This is visible now?
Yes, sir.
Okay. So if you see the foreign tax credit regulations, it says, okay. The credit shall be determined by conversion of the currency of payment of foreign tax at the telegraphic transfer buying rate, or the last month of the month immediately preceding the month in which such tax has been paid or deducted. Now, there is a practical issue because this telegraphic transfer pricing rate, you have to go as per the SBI. So there is some challenges in getting these rates itself. But since it is being paid at a later date, you can go back to the previous months and then take it. But the the tax rules very clearly says how it is to be done.
Right. And sir, where do we get the MLI rates references?
MLI, there's no MLI rate reference. What do you mean by MLI rate reference? I don't know. MLI is basically what? It is a methodology, it's a principle that it has adopted, so that it is universally adopted for all its treaties. I'm only talking about foreign tax credit, elimination double taxation. I'm not talking about the other articles. So if you're talking about any other rates under the other articles, I don't have a solution to it. But in this particular case, India has chosen to adopt a foreign ordinary credit method instead of the exemption method. And that applies to all its treaties, including those treaties where earlier exemption method was concluded.
Right, sir. Yes, sir. These were the major questions that we could answer in the given time.
Okay.
SP Singh, sir, would you like to add some points as a concluding remarks?
I'm very happy we have concluded within the time. Despite me taking the time to make that state tax credit as well.
Yeah,
So,
I have cut short the questions which were already addressed in the PPT or
Okay.
some basic questions,
Okay.
which I request the speakers to do deep dive on your own. Because with the brief introduction what sir has given, say for example, somebody asked, can you repeat the explanation on branch profit tax, something like that, which I request the speakers to do a little deep dive on their own.
No, I will just say branch profit tax is basically an equivalent of a dividend tax. This is something which is prevalent in the United States. Okay. Now, there is a methodology to determine branch profit tax. There is a methodology which says you please take A, B, C into X, Y, Z, and then you get a certain number. It is not necessary that the branch profit tax arises every year. That is the first thing. So just like dividends, it is not necessary for a company to pay dividends every year. They may choose to pay 1 year, they may choose not to pay another year, but consistently many other companies pay dividends. That's a different matter. Similar to dividends, you have a branch profit tax. There's a methodology of computation. It may arise or it may not arise in a particular year. Generally, it does not arise in those years where the investment in the branch is higher than the previous year. If the investment in the branch is lower than the previous year, to that extent, branch profit taxes arise. So in cases where branch profit tax arises, there will be 4 kinds of payments that a company may have to pay. They will pay federal income tax, they'll pay state income tax, they'll pay city income tax wherever it is applicable, state and city tax, and branch profit tax. Because of all of these 4 categories of taxes, the impact of the tax in that particular year will be significantly higher than the domestic tax rate. Even if, let us say, assume the federal tax rate is lower than the India tax rate, but because of the combination of these 4 taxes, the total taxes paid in that particular country may be higher than the India tax rate. And that is where this concept of excess tax credits apply. Because we have got this unusual situation where we have a tax rate paying there, to that extent, the excess tax credits, if it's allowed to be carried forward, then you will be able to adjust those, take credit for the excess foreign taxes in those years where foreign branch profit tax, for instance, does not apply. Because there, to that extent, you may have a certain leverage, so you will be able to get. India does not lose by giving for excess foreign tax credits. India is giving, allowing you a period for you to offset your losses, business losses, capital losses. Why are they doing it? They don't have to do it, but still do it. Similar is the concept for foreign tax credit. India does it, it will be very, very useful to that extent. So I have used this concept of branch profit tax to highlight the relevance of excess tax credits.
Right. Thank you very much. Over to you, SP Singh, sir.
Yeah,
for your
thanks,
concluding remarks.
Krishnanji. I mean, it's you have covered all the points which one can think of regarding the foreign tax credit. It's superficially, it appears to be very, very simple, but as we have seen, once you start going deep into that, because of the differences in the tax policies of 2 countries, there are situations where, in spite of all the efforts, a taxpayer cannot get the full credit of the taxes paid in the foreign country. And since the carry forward is not allowed, which Krishnan has really, I mean, very, given the basis why, I mean, that should be available and would not go against India. It's something, I mean, I think one can take up with the tax department and put to them that, look here, I mean, if those things are, that credit is allowed, that benefit is allowed, it will help, I mean, more Indian companies to have presence outside India. It's a very, very important point, and I will request Krishnanji to write a small note on this, which we can, I mean, take up with the Central Board of Direct Taxes for their consideration.
Sure, sir.
And it's really, you deserve a big, I mean, commendation for the way, I mean, you have covered all the aspects. And as Nagarjuna has rightly said, that what if you write to the committee on taxes, you will get copy of or link to the presentation. Go through that. If you have questions, write to the committee. We'll try to answer to the extent possible. And thanks to Nagarjuna for moderating so nicely, and the support team and the whole team of Direct Access Committee for organizing so nicely and so efficiently. Thanks once again, Pradhan Sahab and Nagarjuna. Thank you. Thanks for.
Thanks. I thank all the participants to having attended this beautiful session on webinar on introduction and intricacies of foreign tax credit conducted by DTC of ICAI. Thank you very much.
Thank you.
Take leave.
Yeah,
Yes.
thank you.
Yes, Raghu.